Hey guys, Ralph here from the Endgame Investor, and today I wanted to talk about Turkey, hyperinflation, stocks, gold, and currency. Came across a very stupid quote in a silly article from CNBC, quoting some guy named Jeremy. What does Jeremy claim? He claims that inflation, as measured by the CPI, is going to reach 25%. And despite that, he's going to stay in stocks because he has no choice. And they're the only things that are real assets that will keep their value. Well, all right. Let's see if that's true. So here's the article. Market is one more bad inflation report away from a correction, Wharton's Jeremy Siegel warns. So there's Jeremy. He's from Wharton. And this is what he says. If the Fed suddenly gets tougher, I'm not sure that the market is going to be ready for a U-turn that Jerome Powell may take if we have one more bad inflation report. The Wharton finance professor told CNBC's Trading Nation on Friday, a correction will come. And here's what he's doing to protect himself from that correction. Subtitle, there is no alternative. Despite his concern, Siegel is in stocks. I am still pretty fully invested because, there is no alternative, he said. Bonds are getting, in my opinion, worse and worse. Cash is disappearing at the rate of inflation, which is over 6%, and I think is going higher. I agree. Siegel anticipates rising prices will stretch out for several years, with cumulative inflation reaching 20% to 25%. Even with a little bit of bumpiness in stocks, and here's the craziest part, you have to be wanting to hold real assets in this scenario, and stocks are real assets, he noted. All that which in the long run is going to maintain value. Well, sure. Well, Jeremy, let's see if you're right on that historically. What happens to an economy that enters hyperinflation? We can go into the past, or we can go into the present. Let's start with the present. You know what's happening in Turkey? They're on the verge of hyperinflation. Let's see what's been going on there with the currency, with stocks, and with their relation to gold.
Eat us 'cause we're good and dead. White man or red man, from east north or south. Chop off our legs and put them in your mouth. Eat me!
In 2012, it took 1.75 lira to buy $1, and now it takes about 11.2. How are food prices doing in Turkey? Well, in July, they were up 25%. In August, they were up 29%, then 29% again, and now about 27%. So it doesn't look like things are going very well there. Inflation rate has been 20% for the last 3 months. The country is on the verge of hyperinflation. Here we have a trusty little chart from Y-Charts that I put together with a kajigger. The top line, the one that's going really, really high up, is gold price in Turkish lira. It's up about 500%. Now, the Turkish lira to the US dollar exchange rate has fallen, looks to be about 82%. So as the Turkish lira collapses against the dollar, this is exactly what happened in Weimar Germany with the mark, kept collapsing against the dollar and doubling and tripling by the day. As the Turkish lira has collapsed, what has happened to Turkish stocks? This, you see here, the iShares MSCI Turkey ETF price percent change. That has gone down by about half, 51% since 2012. So as the lira against the dollar collapses by about 82%, the price of stocks, Turkish stocks, has collapsed about 51%. Why is that? Because stocks have value because they make money, meaning the money substitute of that country. And even if Turkish stocks are making a lot of lira, the lira has lost almost all of its value in real terms. So no, stocks are not real assets. Depends what the stock is. If it's a company that's involved in, say, the production of real assets, then yes, that could be true. But if it's a bubble stock like Tesla, which doesn't actually make any money, then I wouldn't call it a real asset. I'd call it a bubble asset. that makes its money off of transfers from the government and good press. What if we go back 100 years to 1922, 1923, Germany? What happened to the price of German stocks during the Weimar hyperinflation? For that, we can go to a little book called The Economics of Inflation. You can get this at Mises.org. You can also get this shirt that I'm wearing at Mises.org. Let's see here. This is page 264 of 466. The fall in the prices of industrial shares in 1922. After February 1922, the evolution of the share market was quite different from that which had been observed in 1920 and 1921. 1922 was when the hyperinflation really started to take off, and you saw a real collapse of the German mark in US dollar terms, which back then was the gold dollar. Instead of the parallel between the exchange rate of the dollar and the price of shares, there appeared an increasing divergence between the curve of the index number of the share prices and that of the exchange rate. And in the market for securities, an unusual calm followed the frenzied speculation of the preceding months, meaning the price of shares was not climbing along with the collapse in the mark, at least not as fast. I can skip that paragraph. In October 1922, the index number of shares of stock was at lowest level known at any time since 1914. At the beginning of November, the prices of the shares of a certain number of firms whose capital had not been diluted had increased 89 times, and we'll go back to that chart in a minute, compared with 1914. So the value of shares went up 89 times compared with 1914. Well, that's great, 89 times. While the value of the dollar had increased 1,525 times, meaning the value of gold, because the dollar was gold backed at that time. The price of coal, 1,250 times. The price of bar iron, 2,000 times. And the index number of wholesale prices, 945 times. So basically, in real terms, the prices of German shares collapsed. The enormous drop in share prices caused some odd situations. For example, all the share capital of a great company, the Daimler, the car company, was, according to the board quotations, scarcely worth 980 million paper marks. Now, since a motor car made by that company cost at that time an average of 3 million marks, it follows that the bourse attributed a value of 327 cars to the entire Daimler Capital Company. Now, if we go to this chart, you can see these lines that go vertical, wholesale prices in the dollar exchange. The dollar exchange is basically gold exchange. Wholesale prices increased about 4,000 times. The cost of living increased about 3,200, 3,300 maybe times. And here, down here, is the prices of stocks going up about 1,000 times from January 1922 until December 1922. So you see that as the hyperinflation takes its toll, the prices of stocks collapses in real terms. Why is that? Because people are trying to survive. They're taking all their purchasing power and they're putting it into basic needs: food, water, shelter, clothing, not stocks. Those are not real assets. When they do not produce real assets, they are real assets when they produce real assets like energy, gold, silver, other commodities. Then they can really take off. But you can't just be invested in stocks because they are real assets. We see in history that doesn't quite work. Turkey right now is being slaughtered, and all of the people that own its financial stocks and its bubble stocks are also being slaughtered in real terms, and they are scrambling after real assets, real assets, not stocks, but companies that produce real assets and real assets themselves. As consumer prices continue to rise, banks will have to get rid of bonds that are on their balance sheet and give it to the Fed, which will have to buy them in order to maintain their nominal value. And as that continues, inflation price gains will continue to get worse and worse. And as they do, the money that companies make that is the basis of their value in nominal terms and in real terms in the end, basis of the value of these stocks will erode, and all purchasing power will be plowed into basic necessities of food, shelter, and clothing. And so we see that as hyperinflation hits an economy, stocks are not the place to be. Real money is what is needed. And that is why the value of real estate in Weimar, Germany in 1922, 1923, you could buy a house in a swanky area in Berlin for about 4 gold, ounces, maybe 5, about $100 bill. Because in these economies, the need for a real monetary medium is so extreme that the value of everything else falls precipitously in those terms. And those with real money get first bids on the real assets that are left in that economy. That is the position that we want to be in the end game. This is Ravi of the Endgame Investor. Please check out the links in the description below to sign up for a 2-week free trial of my precious metals market newsletter, The Endgame Investor. And if you want to see more of my research into a libertarian commentary on the Bible, then sign up as my patron at my Patreon page. Also, link in the description below. Have a good Thanksgiving and a happy shopping period, and hopefully you can find some stuff on the shelf that you want. But don't be surprised if there are shortages everywhere.